Look at your investment account balance right now. Seriously, look at that exact dollar number on your screen. You probably think that money belongs entirely to you. You think you control exactly where every single dollar goes. Well, let me tell you a brutal truth that will make your stomach turn. Within a few weeks, a massive chunk of your earned savings is going to buy a company that lost nearly $500,000 last year. You will not get a vote on this. You will not get a single choice in the matter. The financial system has already made the decision for your wallet. Elon Musk is preparing the largest initial public offering in human history. We are talking about a target valuation of $1.75 trillion. To put that insane number into perspective, SpaceX would be worth more than every single American defense contractor combined. It would be worth more than the market caps of Coca-Cola, McDonald's, Disney, Nike, and Starbucks. All put together, it is worth more than the top 10 companies on the London Stock Exchange combined. When I was 22 years old working a dead-end job trying to figure out how to save my first $10,000. I thought the stock market was a fair game. I used to drive a beaten-up 2006 sedan with a broken bumper, and I refused to buy a living room sofa for a whole year just to put every dollar into index funds. I thought if you buy good companies that make real money, you win. I thought if you avoid companies that burn billions of dollars of cash, you stay safe. But the game is totally rigged, and the rules just changed right under your nose. If you are wondering who is crazy enough to buy SpaceX at a $1.75 trillion valuation when it loses billions of dollars every single year, the answer is looking right back at you in the mirror. It is you. Your personal retirement account is going to be one of the biggest buyers of SpaceX stock, whether you like it or not. And that is because Nasdaq quietly introduced a brand new rule designed specifically to make that happen. Let us pull back the curtain on this entire multi-trillion-dollar operation. The only way a nearly $2 trillion valuation makes any sense at all is if SpaceX is actually the company the public believes it to be. But it is absolutely not that company. If you ask 10 random people on the street what SpaceX sells most, will say rockets. Some people will say Mars stuff, but both of those answers are completely wrong. SpaceX is not just a rocket company, it is actually 3 totally different businesses stacked on top of each other. And the rocket business is not even the most important one. There is the good, the bad, and the ugly that comes with this company, and trust me, it gets pretty ugly. So let us start right there with the ugly part of the business. It is the part of SpaceX that gets the most media attention and creates the absolute least financial value. Let us talk about XAI. Most people know Elon Musk for owning the social media platform X, but in 2023 he also founded an AI lab called XAI to compete directly with OpenAI and Anthropic. In February of 2026, SpaceX acquired XAI in an all-stock deal that valued the combined entity at $1.25 trillion. With XAI itself accounting for $25,000,000,000 of that total valuation. If you are wondering how it is legally allowed for one of Elon's companies to buy another one of Elon's companies, the honest answer is I have absolutely no idea, but it happened anyway. So with a $25,000,000,000 valuation, you would assume XAI is a financially sound company, right? Or at least close to making a profit, or at a bare minimum that the brilliant people who built it still work there. Well, none of those things are true. XAI was founded with 11 brilliant co-founders who were top researchers and engineers from DeepMind, OpenAI, Google, and the University of Toronto. It was a true heavyweight AI team, but by 2025, the company was burning more than $1,000,000,000 every single month. And by March of 2026, every single one of those 11 original co-founders had walked out the door. Then Elon publicly admitted that XAI had to be rebuilt from the foundations up, which is just the polite corporate way of saying the CEO of SpaceX just paid $25,000,000,000 for an asset that needs to be completely rebuilt from scratch. To say that XAI is overvalued would be a massive understatement. Look at the actual numbers of the competitors. OpenAI generates around $24,000,000,000 in revenue annually, and is valued at around $850,000,000,000. Anthropic generates over $3,000,000,000,000 annually and is valued around $4,000,000,000,000. But XAI, which estimates only $1,000,000,000,000 in revenue, was bought for $25,000,000,000,000,000. The market is pricing XAI like it is a premium luxury airline, but in reality it is a budget airline crashing into the ground. I look at XAI as the ultimate cash destroyer of SpaceX. Instead of printing money, it just burns whatever cash the rest of the business generates. But it is also only one of the 3 businesses inside SpaceX. The other 2 businesses are the ones actually doing the real heavy lifting. Let us look at the rocket business. This is the part most people picture when they hear the name SpaceX. It launches satellites for the US government, cargo to the International Space Station, and crewed missions for NASA. The rocket business at SpaceX generated roughly $400,000,000 in revenue last year, which may sound impressive to a retail investor until you compare it to the $1.75 trillion valuation. Then it suddenly sounds like total pennies, especially when you realize the rocket business represented only about a quarter of SpaceX's total revenue last year, which brings us to the third business, the real crown jewel of the company. Starlink is a satellite internet provider. It is the answer to the question, what if Comcast but in space? Starlink launched in beta in 2020 and 6 years later in 2026. It is the fastest scaling telecom company in human history. There are now more than 10,000 Starlink satellites in Earth's orbit beaming internet, down to over 1,000,000 active subscribers in 150 countries. In 2025, Starlink alone brought in $114,000,000 in revenue, which is roughly 61% of SpaceX's total revenue for the year. 2 years ago, Starlink's profit margins were about 41%. This year, it is now 63%. So yes, the margins are accelerating fast. But here is where the math falls apart completely. In 2025, Starlink and the rocket business brought in roughly $8,000,000,000 in profits, which sounds amazing until XAI showed up to ruin the party, because the consolidated company of SpaceX ended up losing nearly $5,000,000,000 last year on roughly $185,000,000,000 in total revenue. So why on earth is this unprofitable combination about to list at a $1.75 trillion valuation? Because the financial system quietly changed the rules right before the biggest IPO in market history. On May 1st of this year, Nasdaq adopted something called the fast entry rule. And with SpaceX targeting a June date for their initial public offering, the timing is extremely convenient. Under the old rules, a newly listed company had to wait at least 3 months before it could be added to the Nasdaq 100 index. That waiting period existed to give the market time to discover the actual price before passive index funds were forced to buy in. But the new fast entry rule cuts that waiting period from 3 months to just 15 trading days. It compresses 3 months of price discovery into 3 weeks just to speed up the automatic demand for SpaceX stock. And it gets so much worse. There used to be a minimum free float requirement of 10% to join the index. SpaceX is targeting a free float of only 4 to 5%. Under the old rules, they would be disqualified immediately. Under the new rules, that minimum requirement is magically gone. And then there is the hidden multiplier buried deep in the text. For companies with a free float under 20%, Nasdaq now treats the float as 3 times bigger than it actually is, meaning a 4% float gets weighted as if it were 12%. They have bent every single rule and rolled out the red carpet for SpaceX to manufacture artificial demand. They changed the listing requirements, so SpaceX can join the index with just 5% of the company trading publicly. They changed the timeline, so SpaceX skips the standard seasoning period and drops into your index fund in 15 days. And they are forcing exchange-traded funds to treat the stock as if it were 3 times larger than it is. This means Wall Street is building manufactured demand to dump this on you. And while most initial public offerings allocate only 5 to 10% of shares to retail investors, SpaceX is targeting 30%. The chief financial officer of SpaceX, Brett Johnson, told a room full of bankers that retail is going to be a critical part of this IPO. Translated out of corporate speak, they are going to dump 30% of the supply on everyday retail buyers because you love Elon. The buyers are forced in early through index funds, and the insider sellers are unlocked later. Shares move from insiders sitting on a low-cost basis to passive funds, and retail whose retirement accounts absorb them at peak valuation. Your 401k is the ultimate exit liquidity for billionaires. If you hold any US stock index funds, you are going to own this unprofitable combination of businesses within a few weeks. The mechanics of passive investing will just buy it for you automatically without your permission. Traditional financial media will not cover it this way because it does not get clicks. They just want to type a flashy headline about a $2 trillion rocket company, but I am here to tell you the truth because I hate seeing everyday people get slaughtered by the system. Passive investing was sold to you as the smart, safe way to invest with low fees and diversification, but nobody mentioned that the same mechanism that buys the index automatically also forces you to buy whatever overvalued garbage gets squeezed into it. And right now, someone just squeezed a giant $1.75 trillion monster right into your portfolio. Listen to me very carefully if you want to actually understand how money works and stop being the exit liquidity for Wall Street insiders. Hit that subscribe button right now. Listen to how I manage my own capital because I refuse to buy into the hype. When I started seeing these index rules shift, I stopped blindly throwing money into broad market vehicles without checking the underlying components. I choose to allocate a significant portion of my wealth into solid cash. Flowing assets, I like exchange-traded funds that focus on dividend growth and high profitability like SAG. I lean into total market exposure only when the valuation makes actual sense. When you buy an index fund today, you are trusting a committee at Nasdaq or Standard & Poor's to protect your retirement. But those organizations make money from listing fees and trading volume. They do not care if your net worth drops by 20%, because in overvalued tech stock creators, they care about keeping the big players happy and keeping the liquidity flowing. Look at what happened during the dot-com bubble of 2000. Look at what happened to retail investors during the financial crisis of 2008. Every single time the elite need a way out, they engineer a structural change to pass the bag to the public. I remember talking to a friend who lost $50,000 buying high, flying tech stocks at the top of the market cycle. He told me he bought them because everyone on the internet said they were going to the moon. He did not look at the price to sales ratio. He did not look at the net income numbers. He just saw the chart going up and felt the fear of missing out. That is exactly the type of psychological trap that SpaceX and Nasdaq are setting for you right now. They give you a 15-day window where the stock will likely skyrocket due to force buying from passive index funds. You will see the price jump on the news and you will feel like an absolute idiot for sitting on the sidelines. Then you will log into your brokerage account and buy shares at the absolute highest price imaginable. And right when you buy in, the early venture capital funds and the insiders will start quietly unloading their shares. They will take your hard-earned cash and buy real estate or short-term treasury bills yielding a safe return, while you are left holding a volatile asset that is tied to an AI company burning $1,000,000,000 a month. Think about the opportunity cost of having your capital locked up in an overvalued asset. If you put $10,000 into a business trading at a reasonable valuation, you can expect a steady compound return over the next decade. But if you put that same money into a $1.75 trillion company that needs to grow 10 times, just to justify its current price, your money is essentially dead capital. I choose to invest my money where the management is focused on shareholder returns, not on Twitter feuds or colonizing distant planets. I love technology, and I think reusable rockets are incredible, but there is a massive difference between a great technological achievement and a great investment asset. Do not confuse admiration for a founder with a logical investment strategy. When I look at my portfolio, I want to see businesses that have predictable earnings and strong pricing power. Companies that can raise prices when inflation hits without losing their entire customer base. Starlink has some of that power, but it cannot carry the weight of a $250,000,000 AI laboratory that just lost its entire founding team. The math simply does not work. And as your internet brother who has already gone through the pain of losing money on bad trades early in my career, I am telling you to watch your step. Do not let the shiny marketing and the spacesuits blind you to the underlying financial reality. If you look at the top holdings of the major index funds, you will see they are becoming increasingly concentrated in a handful of mega-cap stocks. This means your diversification is largely an illusion. You think you own 500 different companies, but in reality, a few top companies drive the entire return of your portfolio. And now they are trying to add another massive volatile stock to that top tier using artificial rules. It is time to take control of your financial education and stop relying on automatic systems that do not have your best interests at heart. Start looking at individual listings or targeted sector funds that give you true exposure to value and quality. Learn how to read a basic balance sheet so you can spot these corporate maneuvers from a mile away. Knowledge is the only real shield you have against the financial engineering of Wall Street. In the next video, I am going to break down the exact steps I am taking to modify my retirement allocation to minimize exposure to these high-risk index listings. I am going to show you the specific funds I am buying to keep my capital safe while still capturing real market upside. Do not let them play games with your hard-earned savings and your financial future. Stay smart and keep your eyes wide open to the reality of the market. See you in the next one.